Stocks, bonds, mutual funds, index funds, ETFs. You hear people throw these terms around all the time, but what are they? Today, we're gonna find out. Hey y'all, welcome back to Money Mondays. Now, the world of investing can seem pretty overwhelming, especially if you're not very familiar with the terminology and the language that's used in the financial industry. Today, I want to focus on investing for the long term. I'm going to cover 5 of the most common types of investments that people will use to invest for retirement. A few weeks ago, I talked about Roth IRAs and how they are an investment vehicle on your road to financial independence. Now, much like cars come with different types of features like a higher safety rating, Roth IRAs come with their own type of advantages, that being that they are tax advantaged. They help make sure that your income is not taxed when you withdraw it during retirement. Now, if Roth IRAs are the investment vehicle, then the 5 investments I'm going to be talking about are the driver. They're going to determine where your money ends up by the time you reach retirement age. The first investment I want to talk about are bonds. A bond is a loan that you are giving to a company or the government. So just like you have a car loan, student loan, mortgage, etc., in this instance, you are now the lender and the company or the government is the borrower. You get to decide how long the term is. You can buy 6-month, 1 year, even 30-year bond notes. The company or the government pays you back in equal installments twice a year of coupon payments, which make up the interest. At the end of your term, let's say at the end of 30 years, once they've paid off all the interest, they then pay you all your principal back in one payment. People like bonds because they get a consistent payment twice a year and they're relatively safe, especially government-backed bonds, which are going to basically have a guarantee. You also know what the interest is going to be that you're getting as a return for your money. Now, the downside of bonds is that you don't make much money on them at all. If you go look into the interest rates right now, you'll see that bond rates are averaging between 0.09 and 1.68%. So you basically can do a lot better in a high yield savings account without locking your money away for 30 years. People tend to move their money into bonds as they get closer to retirement. The idea is that you've already reached your financial independence number and you really just want your money to be held in one place and not have any risk of dropping in a recession or, spiking in any one way or another. Other than that, if you're young or you still have 20, 30 years left to save for retirement, then bonds aren't going to be where you want to put your money. When you buy a stock, you're investing in a company by purchasing a share of that company's earnings and assets. When a company wants to raise money, they can do so by selling part of their company through shares. The first time a company does this is called going public. This is when you might hear a term called IPO, which is an initial public offering. That's when the company initially presents their shares to the public at a set price, and people can buy those shares for that price. Now, shortly afterwards, the shares are then traded on the stock market where individuals are buying and selling the shares amongst themselves, and the company is no longer involved in that process. This is how people make money with stocks. Much like you buy and sell goods, that is exactly how it works with the stock market. You buy at a set price, and the more people want it, the more you can charge for your stock when you go to sell it. The less people want that stock, the less you're going to have to sell in order to get someone to buy it from you. So that's what's going to determine how stocks are rising and falling in the market and where those rates of return are coming from. Ironically, because stocks carry so much risk, they actually are more attractive to investors because the higher the risk, the higher potential rate of return. That's why you hear all these stories about buying Apple at $1 and now, 20 years later, people are multimillionaires, or buying Facebook at $20 and now it's worth $1,000. There's a lot of potential for that stock to take off if you invest in the right ones. The downside to investing in stocks, other than their high potential risk, is the fact that your money doesn't go as far. For those of us who only have $50, $100, maybe even $500 a month to invest in our retirement, that's barely going to buy one share of stock. For example, if you wanted to buy Amazon stock right now as I'm recording this, you would need to have $3,143 in order to be able to buy one share. That's a lot of money to buy one share of one company. Most of us don't have that kind of money lying around. And so we need to find other ways to invest so that we can take part in investing in the stock market without literally putting all of our eggs in one basket. Mutual funds is like going on vacation with 9 of your girlfriends and everyone pitching in $50 a night for a nice Airbnb luxe beach house, instead of everybody getting their own place, forcing you to get a shared space in Ted's apartment where you're sleeping on a sofa bed and you've got mattress springs poking into your back. The point is, $50 across 10 people can go a lot farther and buy a lot more than your own $50 by yourself. So in the same way, mutual funds pool large groups of people, thousands of people's money together, and a fund manager takes that money and invests in multiple stocks in the stock market. Mutual funds can actually be made up of a combination of stocks, bonds, and other types of assets. It could be all stocks, it could be all bonds. There are a lot of different types of mutual funds out there. Some funds even focus on certain types of assets. For example, one mutual fund might only invest in international stocks and bonds. One might only invest in tech-related stocks and bonds. So it really depends on what your interests are and what you want your money to be invested in for you to decide what type of mutual fund you're interested in. Mutual funds are actively managed by a fund manager, so the actual makeup of your mutual fund can change from time to time as the asset manager is buying and selling different types of stocks and bonds for that mutual fund. Now, because they are actively managed, mutual funds are going to lean to be more expensive than other types of investment vehicles because they have numerous types of fees associated with the fund. Index funds are a passive version of mutual funds, meaning that they do not have an active fund manager. Index funds are used to track an index. An index tracks the performance of a group of assets. For example, the S&P 500, the Dow Jones, the NASDAQ, these are all indexes tracking different groups of companies. The S&P 500 tracks 500 of the largest publicly traded companies in the United States. The Dow Jones follows the performance of the top 30 largest companies in the US, and the NASDAQ follows the performance of over 3,000 tech-related companies. Now, while you can't directly invest in the S&P 500 or the Dow Jones, you can invest in an index fund that tracks the S&P 500 or the Dow Jones. Like mutual funds, index funds come in all different types. There's index funds that track international companies, index funds that focus on energy or oil and gas or tech-related companies, index funds that, like I mentioned, track the S&P 500, the Dow Jones. There are a lot of different options. One of the benefits of index funds is that because they are passive, they're going to have lower costs associated with them. Without getting technical, ETFs, or exchange-traded funds, are basically a type of index fund. They track a benchmark index and aim to mirror that index's performance. The main difference between ETFs and index funds is that ETFs are traded on the stock market like a stock. meaning that anytime during the day, the price of the ETF is fluctuating and you can buy it at varying prices throughout the day. Mutual funds and index funds have one price that are given to it at the end of each day, and you can only buy or sell at that price each day. Like index funds, ETFs also have much lower fees associated with them, so they're going to be a more cost-effective way to invest than mutual funds. A bonus investment I want to talk about are REITs. REIT stands for Real Estate Investment Trust, and they've been around since the 1960s. Basically, a company invests in different types of real estate, and investors are able to pull their money like a mutual fund in order to invest in the real estate. By definition, REITs must own income-generating real estate and distribute that income to shareholders in the form of dividends. REITs are a great way to be able to invest in real estate without actually buying real estate and managing it yourself. The reason I made this type of investment a bonus is because you can purchase REITs on the stock market like a stock. You can buy mutual funds that invest in REITs, or you can buy ETFs of REITs. So it really fits into all of the different types of investments that we learned about today. This covers the basic 101 for the type of investments that you can use for your financial independence journey. There's a lot more to cover, and I definitely want to be able to go over those things in future videos. So if you have any questions, please leave them in the comments below, and I'll make sure to answer those in future Money Monday videos. Thanks so much for joining me today, and I'll see you next Monday.